All right. Welcome to tonight's session where I'm going to review the all-weather strategies, give some weight updates, going to look at the performance and talk about some of the current events that are going on. Of course, if you have been sleeping for the last 48 hours, you didn't know about Silicon Valley Bank. But at the end of today's presentation, I'm going to be talking a little bit about that and how that impacts our portfolio. So let's get started. I'm going to get into it. But before I do put up my screen, just want to welcome everybody. We start off with about 50 people right now, and hopefully we grow. If you're out there and you hear me speaking and you've been here before or you're new to this, feel free to say hi and leave a comment. It always warms my heart to make me feel good. And speaking of warming my heart, you may see that and hear that I've got a little bit of a sore throat, been talking a lot, was a little bit sick over the weekend. So I'm having some lemon mixed with water and honey in hot water. And so that will hopefully cool my voice. All right, let's get started. I'm going to share my screen. And I'm going to kick it off. So remember, you can ask questions in the chat. You can also send messages like Ann said, good evening to you, Ann, and to all others. Ty Amulets, I see is another one in there. So let's go through. We're going to review our strategies and look at all-weather inflation guard. Now, we're going to be looking at February, although we're into March. We're kind of doing this one a little bit later, and so I'll have some updates on things. But all-weather inflation guard was down about 0.7%. All-weather strategy was down about 3%, and all-weather alpha focus was down 1.8. It was a tough month, the month of February. But what I've learned in my career of investing is that whether it's tough or not, you just keep going, keep implementing your strategy, and don't be afraid to talk about it when it's down. Melody, hi. Tasapong, hi. Good to see you. Then we're going to look at the global outlook. And then I'm going to review the new weights of our strategies. For those who are already invested in the different strategies, you've probably already reweighted the strategies with the help of your advisors at Phenomena. If you haven't, make sure you talk to your advisors there. And then I'm going to look at Silicon Valley Bank and show that it's unlikely to take down the financial system. Let's look at all-weather inflation guard. Since inception, the strategy was 0.4% below a 40% equity, 60% bond portfolio. And that's as of March 13th. So the strategy has experienced less volatility. You can see the red line is pretty flat. And the portfolio's held its own when the market has really been tough. Now, if we look at February, the strategy was 0.6% above the 46 portfolio. So even though it was down 0.7, it wasn't as down as the benchmark. Bonds held up well, and only energy did well of the different tilts that we had in the strategy. And also, by the way, I see Lucky. Sawadee ka. I am waiting for this live session. I hope to hear comments about KT Finance. I am. And let me just click on that right there and put that up on the screen. Hold on. I am an alpha focus, and money just goes to KT Finance today. The short answer to it, and I'll talk more at the end about KT Finance, is that I'm going to stick with my recommendation there, and I'll talk about why and what's going on. In fact, if your money went there today, you're probably in pretty good shape. All right, let's continue on with the presentation, and then we'll come to the discussion in just a bit. Now, in the past month, the strategy was 0.2% above the 40-60. So I'm looking at the past month because I wanted to kind of update for the turmoil that's going on in the U.S. market, in particular, what's happening with Silicon Valley Bank. And here we can see that gold and bonds were strong when world financials did crash, going down by about 9.4%. So I want to say thank you for trusting us for 4 years. We've launched the all-weather strategy with Phenomena in February of 2019. I can't believe it's already 4 years. So we'll do our best to continue to deliver. When we started all-weather strategy, we said we have decades ahead of working with Phenomena, but also bringing this strategy to you. And we're looking forward to more time. Now, since inception, the all-weather strategy was 5.6% above a 60-40 portfolio as of the 13th of March. If we look at February, it was a tough month. We were down 3%, and the 60-40 was down only 1.7. So we underperformed that 60-40 in the month of February. Our 25% allocations to commodity and gold were the major cause of underperformance in February. Gold didn't do that well in February. Now, in the past month, the strategy was 0.5% above the 60-40 portfolio. Our gold allocations and also our Japan equity allocation helped the performance. Now let's look at Alpha Focus, where we're taking more concentrated bets. Since inception, the strategy was 1% below the 60-40 portfolio as of 13 March. And we can see that it was 6.9% above world equity as of 13th of March. The purpose of Alpha Focus is to try to get more of the equity upside. Well, it's tough when equity markets are going down, but it's better than if you just put your money in the equity market. We've been able to outperform that and bring a little bit less volatility than the overall equity market. Now, the strategy was on par with the 60-40 in February, and it was about 1.5% above world equity. So when world equity is really swinging, we aren't getting as much of that swing on the upside and the downside. And our 22% tilts, world energy and India, help the performance relative to world equity overall. Now, in the past month, again, trying to take into consideration the turmoil in the U.S. market recently, the strategy was slightly above the 60-40 portfolio. And it was about 1.4% above world equity. And then we do have gold and precious metal miners, which were strong during this time while financials were crashing. This is the power of diversification. There are people that look at gold and they say, you're not going to earn anything on that. Or why do you think gold's going to go up? It's more like a protection when the market comes off. Now, before I continue on, let me just welcome everybody. We've got about 160 people on this call, and I want to welcome everybody. We're going through the performance of the 3 strategies. February was a tough month, though we've been doing okay in the turmoil that's been going on in the U.S. market. Also, I'm going to be talking at the end of this about financials, banks, SVB, and what I think is going on and what to do with the strategy. So feel free to ask any questions in the chat now, and then I'll get to those at the end. But meanwhile, let me go back to the presentation and let's now look at all 3 strategies. Now, this is since we started all-weather inflation guard in July of 2022, then we're going to rebase this to 100 at July 2022. And you can see the all-weather Alpha Focus is much more volatile, and that's what we're trying to do, is get the volatility in the equity market. Right now, that volatility has been a bit rough, but overall, I'm happy with the performance. If we look at all-weather inflation guard, that's the green line. You can see it's pretty flat, not a lot of volatility. That's the purpose of inflation guard. So this gives you a picture, but overall, it's been a tough equity market. So I'm okay that we're holding our own between 97.9 or let's say 98 and 99 for all the strategies. Now, all of these strategies are above the world equity. Remember, part of what we're trying to do is help people that may just put their money in the world equity. Then they're going to get the volatility of that brown dotted line. and we're knocking out some of that volatility. And when we do, we also we lose some of the performance. Of course, you can't get it all. So let's look at the global outlook that guides our asset allocation. Again, welcome everybody. If you've got questions, just put them in the chat. Let's talk about equity. The battle against inflation isn't over yet. High inflation will likely persist for a while. In the long run, equity is the best hedge against inflation, as companies have to adapt to survive. And as consumers and companies turn more optimistic, or at least less pessimistic, we are increasing our equity allocations recently. Now, there's a March 22nd Fed meeting coming up, and right now, a Fed hike is priced in. The market is pricing in a 71% probability for a 25 basis points hike. A few days ago, the market was pricing in a much bigger expectation of a hike, but they've gotten about flat now. Now, let's look at that for a minute. This shows us where things were a year ago. March 17th is the dotted line below. And a year ago, expectations were 2.4, 2.6. And now we can see those expectations are all the way up to 4.8 and 5.0. Now, what's different is this drift that we see downward to 3.6. The market expects that target rate will peak in May of 2023. And the Fed is aggressively tackling inflation, which raises the risk of causing a massive recession too. Here we can see that if we just went back to last week, the 10th of March, 2023, we could see that people were expecting 5.5% for a peak down to 4.3. So recent events in the US bank sector have led people to shift their expectations about how much the Fed can tighten. The peak of Fed tightening is now 5% in May versus 5.5% in July. So people are saying, oh, the banking crisis is going to prevent a banking crisis could prevent the Fed from keeping rates high. The Fed is then expected to lower the rate rather than keep it at a peak for some time. Now, the yield curve inversion started diving deeper. All recessions in the US since 1968 were preceded by an inverted yield curve. And that inversion just grew deeper. At first, I thought it was going to stop. We could see that it was kind of stabilizing at this point, but then it started to go down again. This tells us that about 3 months from now, we should be in recession in the US. Now, for the past year, we've said that we think the course will eventually be reversed, that they can't keep rates high for too long. We still think that central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And we do think that something's going to break. In fact, you could see there was some break in Silicon Valley Bank that supports this thesis that as things break, we could see the Fed reverse. Now, let's just talk about that for a minute. I'm just going to talk about this for a minute. And what I want to talk about is the idea that the Fed basically has raised rates so fast and so high that eventually it's going to cause something to break. Now, when something breaks, what's going to happen? The Fed is going to reduce rates. We've already seen the expectations just in the last couple of days shift to the Fed reducing rates. Why is the Fed reducing rates? Because they're scared that the economy could crash or we'd have some other market crash. And if the Fed was to reduce rates, what's going to happen to the stock market? Stock market would go up. In that case, people would feel like the Fed's going to try to save it by reducing rates, and they could reduce rates very quickly, back down to where we were even. And the point is, we've seen that happen many times. So one of the reasons why you have to be careful is because when you're investing in the stock market, you're really betting for or against the Fed. When I was a young guy in the stock market and starting in 1993, I can tell you there was no Fed setting policy that could change the whole market direction, but there is now. And so that's part of what I think. Sora Nut says, if a John Andrew is the Fed, okay, let's look at this question now. All right, let's see. if a John Andrew is the Fed, what is the next action you'll do in this situation? Well, the problem is I'm a really free market guy. And as a free market guy, I don't believe in the Fed intervening. So I would not be in this situation. That's my first answer. But let's just imagine that I'm the Fed chairman right now and I see what's going on. I think there's not a lot that they have to do right now. The most important thing that they did is basically they said to the banks, the Fed said to the banks that if you have any bonds that you're going to have to sell for a loss because depositors are asking for their money back, then you don't have to sell them for a loss. You can sell them to us, the Fed, and we'll hold them and then we'll give them back to you at some point. And then later interest rates will change and they may not be at a loss. This is what the Fed has just done basically overnight in the last 48 hours. And I would say that that eliminates the big systemic risk. And that systemic risk right now is that people may pull their money out of the smaller or mid-sized banks, and that will force the banks to sell bonds at a loss. This basically makes it so that they don't have to sell at a loss. Yeah, Nan says, poor Powell, baby crying all over. Yes, we'll see what happens. All right, let's keep going. I'm going to switch back over here and go back to my presentation. And let's talk about bonds. Now, they're typically a safe place. In recessions, safer assets like government bonds are typically performing well. Though with high inflation, low yields could still lead to negative real returns. We typically don't allocate the bonds to speculate on the upside, but rather use it as a way to protect capital. Also remember that much of our exposure is Thai bonds, and the Thai government did not increase interest rates as fast as the Fed did, and therefore the value of Thai bonds didn't collapse like the value of US bonds. All right, let's talk about commodities. Energy prices have come down. They've come down massively. This is European gas against the global price of oil, both rebased at 100. And food prices have softened. We can see the food price index. And if the trend continues, it would help to lower the pace of inflation. Now, commodities have lost momentum as energy prices eased due to a mild winter. We don't see a clear catalyst for energy prices to go significantly higher, but we think they can remain high, which supports profits for energy companies. Now, the main upside in commodities could come from a supply shock, adverse weather conditions, or significantly higher demand from, for example, the China opening. I would say that the China opening is not having much of an impact right now. Let's look at gold. Well, recession risk still continues, and gold has kind of held its position for the last few years around here. We keep a relatively high gold allocation in our strategies, which serves as insurance in times of uncertainty. This relatively high gold position, I just will highlight, the relatively high gold position allows us to take some bets on equity. When we take those bets, they could go wrong, but we got gold as a little bit of a buffer to that. And you're going to see more about that coming up. So it's time to announce our allocations. And we love this graphic. Again, welcome everybody. We got 191 people here. Boy, if you could ask me 191 questions, it would be amazing. So feel free to ask any questions that you have. Just type them in the chat, and I'll be happy to try to answer those questions. Also, for the people who have just arrived, we are going to talk about financials and the KTAM Financial Fund, as well as what's happening with Silicon Valley Bank and the U.S. banking system. So here's our inflation guard. Now, we keep equity at 30%. We exit commodities. And this is the little bit of an increase or a strange thing here. We have moved into financial services or world financials. And we've gone out of healthcare, right? And we've exited commodities and increased gold to 10%. That's our position right now. And it would be nice if we could enter financials today or tomorrow. But for right now, that's when we started to get into them. Some of you may have just executed something like that. And so you're in a little bit better shape if you went slowly to execute that. But we'll come back and we'll look at that in more detail. Now, Thai inflation may have peaked, but we keep inflation-linked bonds at 10% just in case they rise again. So what are the risks to our inflation guard strategy? Well, we're mainly exposed to Thai bonds, hence the Bank of Thailand's actions impact the most. Central banks' aggressive rate hikes and QT could crash the market. And collapsing energy prices would be damaging since we have exposure through our 5% allocation to world energy. And also, if banks were to post lower profitability or higher credit losses, our 5% tilt to world financials will get hit. And I would just highlight, at this point that when we look at all of these strategies, we are relatively well diversified. So even if we take a hit in one area, it's not as big of a situation. Keep your questions coming. We now have 206 people on the call. Welcome, everybody. And I know we got a message from Nan, and we also have Kemjira. We'll get to your questions in just a bit. Now let's look at all-weather strategy and the changes to the strategy. Here you can see we've raised equity to 65% from 25%. Within equity, we've increased developed Europe and Japan to 25% from 5% respectively. And we've reduced bonds and commodities to 5% from 25%. So we really are increasing our equity exposure, in particular, Europe and Japan. So we keep gold also at 25%. So our a little bit more aggressive on the equity market is step number one. But keeping gold at 25% is part of protecting the downside. Let's look at that a little bit more. European stocks are relatively cheap. They've been out of favor, and they're trading. Developed Europe is trading at about 13 times PE and 1.8 times price to book versus the world at 16 and 2.4. Improved consumer confidence and PMI add to the attractiveness of the developed Europe equity. That's the Purchasing Managers Index. Now, European energy prices have come down, which supports a recovery in the overall economies. A severe European energy crisis was avoided due to mild winter, and the energy issue has been a leading concern in investing in Europe. Now, I want to talk for a minute. One of the reasons why we look at reconsidering our portfolio every 3 months is because if you get into a bad position, you're only going to be in it for 3 months and then you can get out. Now, of course, if we're in an emergency situation, we may decide to exit something, but generally we wait until the end of the 3-month period. And if something's no longer attractive, you're out. The end result of that is that you'll often find that I'm not holding a strong position or opinion about something for a long time. So you can see right now, I've been pretty negative European equity, but now we're going back in because it's attractive based upon our quantitative valuation or evaluation of the markets. And so just so you know, what I really enjoy about the strategy is that I don't get stuck in something unless I really think that we should be there. And so let's continue on. And China reopening, though it seems to be slower than initially expected, is bullish for Europe because top EU goods export destinations, well, China is a major buyer of European goods. And EU firms stand to benefit from that reopening in China. They need that. Now, the Japanese yen is likely to remain weak. The incoming Bank of Japan governor says he'll stay with the ultra-loose monetary policy. Historically, a weak yen has supported Japanese stocks as it supports exports, but it seems less relevant today with all the international production that Japan is doing, like Toyota in Thailand. For Japan, higher inflation could be positive to a certain extent. Deflation typically reduces consumer spending and slows production. Rising inflation in Japan means the private sector is pushed to invest, not to lose purchasing power by just leaving money in the bank at very low rate. Now, wages may be on the rise in Japan. This is a pretty ugly chart. You can see that even the US wages have not grown that fast compared to, let's say, China. But here we can see that they've massively outpaced the growth in wages in Japan. Basically, wages have not moved in Japan for 30 years. Japanese workforce has hardly seen any salary rise. But large Japanese companies have recently announced salary hikes not seen in decades. So that could be supportive of consumer spending. Now, inflation leads the stock market in many periods in Japan. So hopefully we'll see some of that bounce back. And remember, Japan is cheap at about 13 times PE and only 1.2 times price to book. And it's important to note that Japanese companies aren't anything like the Japanese government. In fact, Japanese companies have very low levels of debt, but the Japanese government has a huge amount. So we've increased our Japan equity target allocation to 25% from 5%. Also, remember that most of the strategies, the mutual funds that we're investing in are hedged for the Thai baht against that currency, like the Japanese yen. Now, what are the risks? Well, inflation reaccelerates and central banks' aggressive rate hikes and QT crash the stock markets. And we're overweight Europe and Japan equities. So if these markets underperform, it will hurt our strategy's performance. And if inflation reaccelerates, we could miss out on rising commodity prices. Our high gold allocation could get hit by higher rates. So if interest rates really rise, that tends to be negative for gold. And finally, the all-weather alpha focus. We've increased our weightings in equity to 85% from 73%. Now, 85% is not the maximum for equities. The maximum for equities is actually closer to 95%. But here we made a lot of changes. So let's look at the changes that we made. We've added 15% European small caps. We've added 7%, a small amount, to financials and precious metal miners, increasing healthcare and infrastructure. So let's look at this. We've raised bonds and gold. We've reduced energy, and we've exited India and commodities. India has failed to show strength relative to global stocks recently, and we find other opportunities more attractive within equity. So let's go and look at some of these allocations. Small caps are typically more sensitive to economic changes than large caps. So here we can see total return indices in Europe, and the small caps have fallen more, but we think they could potentially rise more. So if we look at the recovery there, that's the downfall. Let's look at the potential recovery. Small caps typically can perform better in a recovery period. This is September 2022 till February 2023, so about the past 6 months. Smaller companies generally have better growth prospects and are more agile in capitalizing on new opportunities. So we've added a 15% target allocation to European small caps. Now, the energy sector can perform well even if oil prices don't rise. Oil prices are still elevated, which supports energy company profits and potentially new investments. Now, rising interest rates should benefit banks' net interest margins, and we can see kind of the rise that's been going on right now. We've added a 7% target allocation to world financials, and we're going to come back to that in the final section of this report. But that was our allocation about a week or so ago when we came out with this, and now we're discussing it in a little bit more detail. Now, precious metals don't always move like overall commodities, which you can see here. They're not necessarily perfectly correlated. So we are interested in precious metals and what's going on with gold. Gold and other precious metals, to some extent, can gain from uncertainty and recession. Palladium, platinum, and silver have industrial applications and are important for green energy and EVs. Precious metal miners can benefit from sustained high prices, and these are rough estimates of the profit that miners on average can make at current prices, which we can see miners are making a lot of money for silver, palladium, and gold. And miners are also expected to move with a beta greater than 1 time relative to spot prices of gold. So let's look at that. We've added a 7% target allocation. So gold recession pushing down stocks is a major risk. And Central banks' aggressive rate hikes in QT crashed the markets. That's another problem that could happen and hurt our portfolio. Collapsing energy prices would be damaging to our 15% tilt to world energy. If Europe turns small caps, could get hurt more than the overall European market. And if gold performs poorly, we could take a double hit through our precious metals, miners, and gold allocations. All right, now it's time to look at Silicon Valley Bank. We've all seen the headlines like this during the weekend, talking about the crash that's happening in Silicon Valley Bank. It's been extra painful to see when this happening as we added 7% target allocation to world financials in AWAF and 5% in AWIG. Keep in mind, in all of our strategies, like in AWIG and AWAF, we are trying to take a heavy tilt. Now, in the case of inflation guard, it's a tiny amount, right? Now, panic is seldom the best response when investing. The benefit of an investment framework is that it forces discipline when emotions run high. And they're running high right now. Emotions from wild market events can cause you to make rash and costly decisions. To avoid this, we stick to our framework. And our framework relies on data and structure, not just on feeling or opinion. So this does not mean it's easy to make decisions when things are crashing. It only means that we try to make investment decisions that aren't based on emotions. It doesn't mean we're always going to be right. It means we decide based on our framework, and we think that this has a higher probability of occurring. We weigh that against the risk of the decision. So let's dig into our position in world financials, and this will answer the question that we've had earlier. The fund that we're invested in is called KTAM, World Financial Services Fund, and its master fund is the Fidelity Fund, which is Global Financial Services Fund, and the master fund held 72 positions as of 28th of February. So already we know that there's thousands of banks in the US in particular, but here this fund only owns 72 positions. So they're really into the large cap banks. Now, according to KTAM, their disclosure is that Silicon Valley Bank accounted for 0.46% of the fund's NAV. So at 100% loss, which is very likely that that is gone, the impact would be 0.4% to the NAV of the fund. Now let's look at some more details of the master fund. That's the Fidelity Funds, Global Financial Services Fund. The fund is overweight the US and UK and underweight China and Switzerland. Here we can see a 59% of the fund's assets are allocated to the US, and that means 60 US, 40% outside of the US. The top 10% positions are concentrated in large banks and insurance companies. So it's not just pure finance companies or banks like JP Morgan. It's also financial holding companies like Berkshire Hathaway, which is 4% right there. We've got 10% of the portfolio almost right there. Also, there's some other companies that are non-financials, or as we see Charles Schwab here, they're not strictly banks. It is financials, banks, insurance companies. And the top 10 overweight positions are concentrated around insurance, brokerage, and wealth management. Some of you know Julius Baer, and they have their operations abroad and also provide some services in Thailand. And this gives a picture. We've got reinsurance as an example right here. So this isn't like a broad-based small cap bank. So here we can see 87% of assets are invested in companies with a market cap above 10 billion euros. So mainly it's large cap. Now, U.S. regional banks, which are smaller, have been hit the hardest. Of the top 5 U.S. regional banks with the most uninsured deposits, the fund has positions in 2 of them. And so it's very possible that it could lose those positions and they go to 0. 0.9% of assets in Western Alliance and 0.78 in Comerica. So the impact is expected to be limited. It's still a negative impact, of course. So does this mean the worst part is over for financials? Well, the honest answer is no one really knows. We think the market has overreacted to the current information. As such, if we were to exit financials, we risk selling at the bottom. And it's all a matter of the contagion. And so far, the Fed has signaled to do what it takes to prevent widespread contagion. Now, that financial services fund we hold appears to have limited exposure to the biggest risks that we're seeing right now. The fund seems to have little exposure to the U.S. regional banks, which are currently facing the biggest problems. What we've seen so far is failing banks are likely to be transferred or sold to big banks. And in the long run, it means less competition for the large banks. So it's very possible that we could see a bounce back in that as funds move from the small regional banks into the larger banks, which is where this fund is concentrated. Now, remember that the Fed is expected to have to pivot. That's part of what's starting to come out from people's expectations since Friday. Market participants have changed to expect lower rates already in June and expect the Fed to do whatever it takes to support the banks. It's all about trust at the end of the day. The biggest risk is that enough market participants lose trust in the financial system. If that happens, it's going to get worse. Right now, we don't see that, and we keep our 7% weight in Alpha Focus and 5% weight in Inflation Guard. We monitor that situation daily, and we may change that position if new information suggests that we're wrong. But I don't see a reason at this point to lock in some losses that we got on that. Also, we have relatively high gold allocations. In Alpha Focus, we have a 9% gold allocation, even though it's a pretty aggressive equity fund or strategy. In all-weather strategy, we have 25%, and in Inflation Guard, we have 10%. And so basically, what we can see is gold is often inversely correlated to financials in big crashes. Overall, gold is uncorrelated to financials, basically no correlation. And we know that generally the correlation coefficient turns negative in financial crashes. What does that mean? That just means that if markets start to crash or financial companies start to crash, people put their money in gold. So gold is ultimately insurance. And miners are leveraged gold, so there's more volatility in the miners that you can see. The red line is much more volatile. The beta is about 1.6 times for that whole period. And correlation was about 78%. This means on average that you'd expect miners to move 1.6% for every 1% the gold price moves. So the key takeaways are the biggest risk is that enough market participants lose trust in the financial system. And right now we don't see that. And we keep our 7% weight in all-weather Alpha Focus and 5% in all-weather Inflation Guard. We have relatively high gold allocations, which should help protect the downside if we're wrong. All right, before we get into Q&A, the Valuation Masterclass Bootcamp number 9 starts on May 1st, and our limited super early bird price is still available. And with Phenomena, you can save $100 to join. We have had many people come from Phenomena, and they've learned a lot about valuation. So you can get that 100% off on any price up until the 21st. You can save $800. Just use that coupon code or go to valuationmasterclass.com/bootcamp. All right, it's on to Q&A. I'm going to close out the presentation, and I'm going to get into Q&A. Let's do that. I'm going to switch my camera here, and I want to go up to the beginning of Q&A. And so the first one was Lucky, who asked me, am I going to talk about KT Finance? And now you've heard a little bit about it. And what you can see is it's 70 holdings. It's focused on large caps. It's 60% in the US. And it's not just banks. It's also insurance and other financials. So that gives you a little bit. There is exposure to SVB, which is about half a percentage point, which probably goes to zero. And then there's two other banks that could potentially go to zero. That would knock about 1 to 1.5% off. So there are issues there. But I also think that what can happen is that funds go out of the community banks, the regional banks, and into the biggest banks. And that is where this fund is positioned. And so I don't feel like it's time to sell it because we would just lock in losses that I just don't think are necessary at this time. I was a bank analyst for my first 10 years as an analyst. And I can say that from my look at the banking sector in the US, I'm not so worried about it. All right, let's continue on. All right, what else do we have? Remember to ask your question. We have 212 people on here. Could we have 212 questions? Well, maybe not, but feel free to ask your question and I'll try to answer it. Some said Yellen team should do something now. What else she can do apart from raising her high voices for Fed to work and go to raise debt? You know, the truth is that I don't like at all what's happening in the US, because what's happening is that no matter what crisis happens, the Fed and the Treasury just come in and try to, save the day. And that's not a free market. That's what America is, a free market. But now we've got markets are so not free anymore that now the government has to intervene on just about everything, right? Let's look at this for a moment. Kem Jirel says, now the U.S. met the situation of financial crisis. Will Biden still have a problem with China? Yes. I don't think that this will, there's still a chance that we have a further problem with the financial sector, but I think I'm not too concerned about that right now. As far as China is concerned, I think it's, I just talked with two people I interviewed on my podcast who are experts in the space of China. And both of them basically said, yeah, unfortunately, the U.S. is on a war path for China. So that makes me a little worried. All right. Nan says CPI was exactly 6%. For those people that didn't see it, what we can say is that CPI declined to 6% on a yearly basis in February from 6.4% in January. On a monthly basis, CPI was up 0.4%. The core CPI, which includes volatile food and energy prices, rose 0.5%. And on a monthly basis, compared to market forecast of 0.4%, bringing the annual down to 5.5% from 5.6%. So still, we're seeing that inflation is slowly coming down in the U.S. Globally, inflation is either going higher or staying high. All right. There's a message from Somkuan, I think, and it says, Sawadee krap. Yep, Sawadee krap, Kun Somkuan, nice to see you. All right, Nan says, your position in finance, Japan, Europe, is come before or after the SVB announcement. You foresee this will happen? All that came before the SVB announcement. So I did not foresee what happened with SVB. And at this point, I would keep the positions as they are for right now. And let's see how it goes. All right. So for those people that are interested in the Valuation Masterclass Bootcamp, you can just click on that link. Alex has put it in for me there, and that gives you access. Well, I don't see any more questions. It's 7:44. We've got 218 people on. Do we have any more questions? Okay. Salaya DC says, what is your view on the Thai banking sector? I would say the Thai banking sector is in pretty good shape. Already the fact that it made it through the crisis without like major injections of capital when the economy was shut down, when the property sector was being hit, when tourism was shutting down hotels, the Thai banks proved to be pretty strong through that. Now, as far as the situation in relation to SVB, we also don't have the problem that we had in the U.S. In the U.S., the government handed out a ton of money. Where did that money go? It went to deposits. People put deposits in the banks, and the banks didn't know what to do with it. And so they put it into treasuries. They put it into government bonds when government bond yields were very, very low. And then they didn't expect that government bond yields are going to fly up, which they did, which destroyed the value of those bonds. So the U.S. banks had a trouble of too much deposits. And most of them, like the big banks, they hedged this interest rate risk, right? Interest rate risk is the risk that you buy a bond that's yielding, let's say 1%, and all of a sudden new bonds come out and they're yielding 3 or 4%. And all of a sudden your bond's not worth so much. You have to mark down the value of that bond. And so Thai banks didn't have this boom of deposits. And so from an SVB's perspective, I would say it's not a major issue. I'm not worried about Thai banks in relation to this. All right, let's see. What's your view about property and REITs? That's from Titiwan. I would say, the question is, are you asking about the US or are you asking about Thailand? If we're talking about Thailand, I would say pretty stable. REITs are a pretty good investment that give you a, high dividend return. If we're talking about the US, I would say there's still downside for REITs and property, in my opinion. So I'm not overweight REITs yet. So I'm still kind of negative on them in the US. All right, Tawisap. Okay, you guys are starting to ask questions. I love it. We've got 208 people on this call, and Tawisap's got a question. What's your view about R? Oh my God, what is R? Okay, wait a minute. It could be that you were saying something here. Okay, what's your view about Vietnam and China? Right now, Vietnam and China, I did not allocate to either of them in my latest rebalancing, which tells you from my FVMR methodology, I'm not positive on those two markets right now. So I can just tell you, because I haven't gone into those markets, they are not attractive to me. All right. Nan says, your view on Buffett buying Oxy, long-term or short-term, like TSMC shares? I would say probably long-term, because Oxy's got, a lot of exposure to petroleum, to gas, to oil. And basically the main thing about this is just that Buffett's smart. He's playing both sides of the bet. He's owning something like a railway, like BNSF, and he's owning something like oil, and he's betting, in this case, kind of for ESG and all that by owning a railway. And then he's betting against ESG and saying, I think oil prices are going to be rising. You could say he's betting for ESG, because you could argue that basically what the asset managers are doing is they're withholding funds from from energy companies. And as a result, basically, they're making actually energy companies have a scarcity. And so that's an interesting point. So I would say long-term. Petra Pan, which markets do you recommend in this situation? Well, as you can see, Europe and Japan are interesting to me. The US is still interesting. Or which assets? Well, I would say I've started to tilt more towards the equity asset class, but I'm still holding a relatively high position in gold, particularly in AWS. So I would say those are the two asset class I'm kind of most interested in. Pochida says, what is your view for crypto funds? Is there any impact from SVB crisis? I would say crypto funds are facing a much more painful situation than SVB. We've had so much going on with volumes collapsing in the crypto market, and with crypto prices falling and crypto assets, some of them disappearing or shutting down, that all of that is putting tremendous pressure on crypto exchanges, on crypto funds. And I would say we probably are getting close to the bottom of that. If I was thinking about allocating the crypto, I would think that now or the next few months, or maybe the next 6 months, would be a time that maybe it's worth it to look at crypto again. But for right now, I would say SVB is not really that related to crypto. All right. Okay. Titiwan says Asia REITs. I think that Asia REITs are okay. They provide a good yield. We have Capital Land REIT as an example that's providing a pretty good yield. So I would look at that one. I think you're talking about both Thailand and Singapore. I would say those are pretty good investments. The only thing that you could say about the REITs in Asia is that if the markets turn, let's say that money comes into the emerging markets, or in particular into Asia, you may not see that you're going to get as much upside on REITs. But from my perspective, REITs they're very solid. So they're a good portion. They can be a good portion of a portfolio to control the risks. NTPK says, good evening, Krap. In your opinion, what do you think about Fed interest rate decision for this upcoming announcements? Also, the market reactions. I think that the Fed chairman is going to continue to raise rates. He doesn't want this SVB price situation to cause him to stop raising rates. And what you can see is that they've tried to shut down any risks pretty quickly. And the main risk that they've done at the Fed is that they've allowed banks that would be forced, because people are taking out deposits, they would be forced to sell bonds at a loss. They're allowing them to sell those bonds to the Fed at face value. And that basically is all the protection that all the banks, if that had happened before SVB happened, SVB would not have gone bust. But they weren't providing that type of protection. So by providing that protection and setting off this warning to all the banks, like, holy crap, you better be careful about your interest rate risk, I think that part of it's doing is setting up so that the Fed continues to be tight in the policy. As far as a rate hike, maybe 50 basis points, 25 possible in the next one. Kumpon says, is it wise to hold cash 100% right now? I would say it's never wise to hold 100% cash. I know that it feels scary and it feels like you're doing a smart thing, but the fact is that so many times what I've learned is that you build a long-term portfolio and you trade around kind of the core of that portfolio. The idea of going 100% in cash versus being diversified just doesn't make sense to me. I think over the long run, you could spend many years 100% in cash where you're not earning anything. And you think that you're getting out at the right time. But remember, for every time that you get out at the right time, you also have to get back in at the right time. And that's hard. So to answer the question, I would not go 100% in cash. Now, if you don't have a lot of savings and you got to be careful about your assets for your retirement or something like that, okay, put a portion in cash is fine. But I wouldn't go 100% ever. KT says, why investors sell stocks and switch to bonds? The U.S. 2-year bond dropped sharply instead of holding cash. As we observed, the dollar index is not moving much. Well, they are getting a high yield on that bond, right? And they're thinking, well, interest rates are already high. And in fact, interest rates could be going down. We've already seen that they've been adjusting down their expectations on interest rates. And so they say, well, short-term bonds have a really high yield because the yield curve's inverted. And I think that interest rate expectations are falling and interest rates could fall. And therefore, I'm holding this short-term bond at a very high yield and it could increase in price. And this is why I think people are moving from stocks into short-term bonds. They're hesitant to move into long-term bonds because they're afraid if interest rates start to rise again, then they could be hit because, of course, long-term bonds are more volatile than short-term bonds. So that gives a picture of why I think that's happening right now. All right. Wow. You guys really came through with a lot of questions, and I think they're good questions. If you've got any final questions, we've got about 5 minutes left until it's Andrew's bedtime. So let's look at the next questions that you guys have. Kemjira says, Fed buy the bond from the problem banks. Just they do QE again. How about inflation? Will that be bigger? So yes, it's very similar to QE in the sense that the banks, the difference is the purpose of the banks selling the bonds to the Fed was to inject cash back into the banks. So the banks needed cash. They gave the bonds to the Fed. The Fed injected cash into the banks. But then the U.S. banks didn't even lend that cash. But here, what they're basically saying is, look, if you have a run on your deposits and you have to sell at a loss, then transfer those to the Fed. And then the Fed will pay you at face value, which will prevent the outflow of deposits. You'll be able to match the outflow of deposits. So I wouldn't say it's going to have a big QE or inflation impact. Also, because many banks don't need to do that because they've already hedged their inflation, like JP Morgan as an example. All right. Puchida says, is there any kind of fund that targets to make profit on exchange rate difference? Not that I know. And I try to stay away from exchange rate funds that are or strategies that are trying to make money off of exchange rates, because in the end, exchange rates are a zero-sum game. When one's going up, another one's going down. And also we know that it's really central banks and the Fed that are fighting it out in the Forex market, and you can really lose big in that market. All right, keep those questions coming. We got 3 more minutes. Titiwan says, you put more weight on Europe. Is Russia and Ukraine less serious now? Yeah, I guess at this point, I'm starting to see momentum coming into Europe. I'm hopeful to ride that momentum. Of course, we could always have a problem, but I think what's happening right now is that America is probably losing some of its interest in that war. And at some point, we're going to end, the war is going to end, and it's going to be some kind of agreement between Ukraine and Russia. Russia will keep control of a portion of Ukraine, and there'll be a settlement. So that's where I would say at this point, it looks like Ukraine and Russia is less serious to me. KT says, how can the Fed bring down inflation to 2% target when the U.S. government fiscal policy is not helping the Fed? Well, exactly. It's going to be almost impossible. It could take 5 to 7 years before the Fed is able to get back down to 2%, because the federal government just keeps spending. It's an enormous amount of spending. So yes, it will be very difficult. I think I would expect inflation over the next 5 years at maybe 4% on average. Kumpan says, what currency do you think will hold its value in the future? The Thai baht. I think currencies like the Thai baht, as an example, countries that don't have a lot of debt should do well. And I do believe that the US dollar at some point is going to start to lose its value. And that's where currencies like the Thai baht, I think, will be stronger. So looking for currencies that have relatively strong current accounts and they don't have a lot of government debt. So overall, I would say at this point, Thai baht to me looks very good. All right. We have time for one last question if it comes in within the last minute. Otherwise, I want to say to everybody, thank you for joining tonight. You got great questions. I've tried my best to answer it. Hopefully, from what I've answered, you've been able to understand a little bit more about how we position the strategy. I do also want to say that it's important to be diversified. And as I've shown you, even some of the fall in the financials is being offset by the rise in gold. And so always try to diversify your portfolios as best that you can. And also be careful not just to go out 100% of the market, because I think that ends up being a mistake in the long run. So I want to thank you all. Po Chida says, get well soon. I appreciate that. I have a sore throat. I've been talking all day. So I'm going to head off to bed. But I just want to say to everybody, thank you for joining. Thank you for your awesome questions. Feel free to keep contacting me throughout the week and through the next time that we meet again. And if you have any problems or questions, make sure to talk to your advisors. Remember, I'm not your advisor, but you've got an advisor at Phenomena and other great people at Phenomena that can help. So thank you all for attending. And I hope to see you very soon. Have a great evening. It's 8 o'clock. Hug your loved one and go to bed.